In 2025, the Federal Reserve cut rates 3 times, totaling 75 basis points, finally clarifying the direction of liquidity and prompting a reset in risk asset pricing. Meanwhile, uncertainty persisted throughout the year. Precious metals kept rising, repeatedly hitting new highs, and became a key hedge against macro and geopolitical shocks. On the equity side, AI-related stocks surged, with a handful of tech giants increasingly driving overall index performance. These trends together set the tone for 2025 and define the market's key characteristics. The first market shock of 2025 didn't come from policy, it came from AI. Early in the year, Chinese AI startup DeepSeek released its open-source model, DeepSeek R1. It delivered near-frontier performance using a fraction of the computing power markets had assumed was required. The impact showed up quickly. The global AI competitive landscape shifted, challenging the notion that high-compute models dominate. Valuations for software and algorithm-heavy companies increased relative to hardware-focused firms. NVIDIA and other high-compute companies saw short-term volatility as markets reassessed future demand. By February, analysts projected AI capital expenditures to reach $500 billion in 2026, indicating a structural trend. Markets started the year optimistic briefly. After Donald Trump's inauguration on January 20th, equities initially rallied on expectations of deregulation and more business-friendly policies. The S&P 500 rose towards 6,200 by mid-February, while Nasdaq gains were concentrated in tech. However, this optimism was fragile as trade risks were brewing, signaling the market's sensitivity to policy shifts. Trump's reciprocal tariffs shake global markets. The deepest drawdown of 2025 started with one announcement. In early spring, President Trump announced reciprocal tariffs, 10% on most imports, higher duties for selected countries. Immediate market impact. S&P 500 fell nearly 20% over 7 weeks, bottoming near 4,800 by early April. Dow Jones Industrial Average dropped around 18% in the same period. Treasury yields declined as capital flowed into bonds. Gold prices surged, with ETFs seeing record inflows. The move also raised concerns about 2025 GDP growth, projected to decline due to trade uncertainty and increased short-term inflation expectations. What began as tariffs quickly turned into a trade war. China retaliated with broad tariffs and export restrictions on strategic goods. Market consequences. Cyclical sectors, including industrials and exporters, underperformed by 12 to 15%. Supply chain risks pushed commodity prices higher, increasing inflation uncertainty. Investors rotated into defensive sectors and safe haven assets like treasuries and gold. This period intensified risk-off sentiment, highlighting the global interconnectedness of trade and equities. While markets argued about direction, gold focused on protection. Gold prices repeatedly hit record highs, ending the year up around 20% YTD. Driven by trade wars, geopolitical tensions, and monetary easing. Gold ETFs saw inflows totaling over $50 billion. Central banks increased gold reserves by over 400 tons globally. Gold's role as a hedge was reinforced, especially during S&P 500 dips of 10 to 20% in early 2025. It consistently offered stability amid market uncertainty. In 2025, even personalities moved markets. Public fallout between Elon Musk and Donald Trump triggered volatility in Tesla shares. Tesla experienced swings of plus or minus 15% within days. Event-driven trading intensified, with derivative volumes spiking 25%. Broader tech indices saw temporary repricing to factor in political uncertainty. It illustrated how individual actions could materially affect equity pricing in concentrated sectors. Crypto split into two roles: volatility and stability. As liquidity conditions shifted, Bitcoin surged above $120,000 in July, but dropped below $90,000 during risk-off periods. Multiple 30% plus swings occurred across months. Stablecoins expanded by 30% plus in market capitalization, providing a liquidity buffer. Crypto trading volumes hit $50 billion daily at peaks, emphasizing sensitivity to macro events. Crypto increasingly traded like a macro risk-on/risk-off indicator, while stablecoins acted as on-chain cash. The most important shift of 2025 came quietly. The Federal Reserve cut rates 3 times, totaling 75 basis points, to 3.50 to 3.75%. Market reactions. 10-year Treasury yields fell from 4.2% to 3.8%. S&P 500 rose 5% post-announcement, supporting broader risk assets. Gold and crypto rallied, reflecting renewed risk appetite. This marked a structural pivot, as monetary policy stopped being a constraint on risk assets. At one point, AI wasn't just a theme, it was the market. In October, Nvidia surpassed $5 trillion, Apple and Microsoft crossed $4 trillion. AI-driven megacap tech dominated indices, with Nasdaq 160% concentrated in top 5 names. Valuations reached unprecedented highs, sparking bubble concerns. The concentration emphasized both the upside and systemic risk of the AI-led rally. The longest government shutdown barely shook markets. A 43-day shutdown delayed key economic data and increased short-term uncertainty. S&P 500 dipped only 2%, rebounding quickly. Volatility spiked temporarily in cyclical sectors. Markets demonstrated resilience despite policy paralysis. Just as markets questioned AI valuations, competition intensified. Google launched Gemini 3, featuring advanced multimodal capabilities. Analysts projected a 10 to 15% acceleration in AI adoption for enterprise applications. Competitors like OpenAI reassessed development timelines, raising strategic pressure. Market impact reinforced big tech dominance and contributed to short-term tech volatility. The event highlighted the accelerating arms race in foundational AI. By year-end, markets weren't euphoric, they were cautious. Volatility indexes ticked up 10 to 15% from lows. Leverage remained muted. Trading volume stabilized without major spikes. Markets were positioning, not pushing, preparing for potential 2026 catalysts. What 2025 really was. 2025 wasn't the cycle. It was the reset. Across the year, markets repriced repeatedly. Policy risk, AI leadership, liquidity, and risk appetite. Not an ending. A rehearsal.